Markets don't usually collapse when the headlines are loud. They crack when the real decision is buried in footnotes, policy language, and dates no one circles on a calendar. While investors were glued to trade headlines and diplomats were smiling for cameras, a far more consequential move was already locked in, quiet, deliberate, and timed with precision. This isn't about tariffs. It isn't about posturing. It's about control over a metal that sits at the heart of modern energy, technology, and national security. And it all comes down to one date. January 1, 2026. While the world was busy celebrating the so-called China-US trade truce in November, after Beijing announced it was suspending export controls on rare earths like gallium and germanium, something far more serious slipped under the radar. China never unlocked silver. Instead, it quietly set an expiration date. January 1, 2026. Just 21 days away. This isn't another routine export rule. It's a carefully engineered choke point, one designed to tighten around U.S. supply chains the moment the calendar flips to the new year. Look back to what happened in Busan last month. Trump met with Xi Jinping. Headlines declared progress. Analysts rushed to announce that the trade war was thawing. Reuters reported that China had eased controls on rare earths, gallium, germanium, even antimony. Markets exhaled. Wall Street applauded. But what almost no one noticed was what Beijing didn't give up. China relaxed restrictions on materials it could afford to lose, while quietly doubling down on the one metal the energy transition cannot function without: silver. Today, silver trades around $62 an ounce, up 115% since January 2025. The previous all-time high of $61.94 is already history. But this price surge isn't fueled by speculation or retail enthusiasm. It's positioning, early, deliberate positioning ahead of a supply shock most investors still don't see. To understand what's coming, rewind to October 2024. That month, China exported 660 tons of silver, the largest single-month export on record. The metal flowed straight into London Metal Exchange vaults, COMEX warehouses in New York, and Swiss refineries feeding Western buyers. On the surface, it looked like business as usual, China meeting strong global demand. In reality, it was a controlled evacuation. Chinese exporters knew the clock was ticking. They shipped every ounce they could while the door was still open. January 1st was already set. The exporters understood what Western financial media missed entirely. This wasn't demand being met, it was inventory fleeing before the border closed. Think of it like the last flights leaving an airport before the government seals the runway. The mechanism behind this move is subtle, and that's why most analysts missed it. China didn't announce an outright ban on silver exports. That would have triggered immediate backlash. Instead, Beijing implemented something far more effective: a licensing monopoly. Starting January 1st, only companies producing 80-plus tons of silver annually are even eligible to apply for an export license. How many Chinese firms meet that threshold? Fewer than 20. And every single one has deep state ties: Zijin Mining, Hunan Yuguang, and other enterprises aligned directly with Beijing's strategic priorities. Independent miners? Locked out. Private exporters? Gone. Spot market purchases by Western buyers? Eliminated. If you're a U.S. solar manufacturer that needs 1,000 ounces of silver next quarter, you no longer negotiate with the market. You negotiate with Beijing. Your counterparty is no longer supply and demand, it's a state-approved exporter reporting to MOFCOM, China's Ministry of Commerce. The choice of January 1st wasn't arbitrary. It was surgical. First, it came immediately after the November trade talks, right when the U.S. was celebrating concessions on rare earths. While Washington declared victory and financial media wrote about de-escalation, silver controls stayed firmly in place. Classic misdirection: give them what they expect so they don't notice what you keep. Second, January 1st is when U.S. manufacturers lock in Q1 supply contracts. Solar firms, electronics producers, medical device manufacturers, all finalize January, March deliveries in mid-December. This year they can't. The approved exporter list won't even be published until late December, leaving American buyers scrambling with no warning and no alternatives. Third, and most telling, the date lines up perfectly with China's own inventory situation. Shanghai Futures Exchange silver inventories have collapsed to 780 tons, the lowest level in 10 years. In 2019, those same warehouses held over 2,400 tons. That's a 67% drawdown. Where did the silver go? Straight into China's factories. According to the Silver Institute, China's industrial silver consumption now exceeds 5,200 tons per year. Solar panels alone account for 3,500 tons. Add electronics, EV batteries, medical equipment, water purification, industries. China dominates globally, and the picture becomes clear. China's domestic mines produce roughly 3,600 tons annually. That's a 1,600-ton deficit every single year. They've been filling the gap through imports and recycling. But once exports tighten, that deficit becomes someone else's problem. Specifically ours. And here's the moment that confirms this was coordinated at the highest level. On November 7, 2025, just 1 week after China announced its silver licensing rules, the U.S. Geological Survey added silver to its official critical minerals list for the first time. That language matters. Essential to economic and national security. Supply chains vulnerable to disruption. Translation: the U.S. government quietly admitted we have a silver dependency problem and China knows it. That's why silver was the one metal Beijing refused to release while appearing cooperative everywhere else. January 1st isn't just another policy date buried in a bureaucratic calendar. It's the moment U.S. buyers lose direct access to the world's largest silver exporter, after contracts are signed, after inventories are committed, and after alternatives are gone. And the numbers prove this squeeze isn't theoretical. It's already happening. Now look at the policy itself. MOFCOM Announcement Number 68 of 2025, issued October 30th. This isn't regulation. It's consolidation. To qualify for an export license, companies must meet 4 barriers. 80+ tons of annual production. 200 million renminbi in credit lines, about $28 million. Full ISO 9000 and ISO 14000 certifications plus complete social insurance compliance. Documented export history from 2022-2024. Miss one requirement? You're out. The application window closed November 12th. Provincial bureaus consolidated submissions. After a brief public notice period, the final exporter list will be locked in for 2026-2027. No new entrants. No competition. No price discovery. This isn't a quota. It's not a tariff. It's a licensing monopoly, one Beijing can tighten or loosen at will by adjusting who stays on the list and how much they're allowed to ship. Invisible to outsiders. Absolute in control. To understand what's really unfolding, you have to step away from futures charts and paper prices. Because the real warning signs aren't flashing on trading screens, they're showing up in the physical silver market, where supply stress can't be hidden. In March 2025, silver lease rates in London suddenly exploded past 15% annualized. Under normal, well-supplied market conditions, lease rates barely register, typically near zero, maybe 0.5% at most. A move like this doesn't happen because of speculation. It happens when physical metal disappears. By September, as supply stress intensified, lease rates surged to nearly 30 times their normal level. Traders on the ground in Singapore reported something extraordinary. Major banks simply couldn't find leasable silver to complete routine commercial transactions. In Zurich, refineries began rationing metal even to long-standing clients. This wasn't a one-week squeeze. It dragged on for months. Industry estimates now suggest that freely circulating silver, metal actually available for immediate commercial use, not locked away in ETFs or long-term vault storage, has fallen below 4,000 tons globally. In a healthy market, that number would typically exceed 15,000 tons. So what's driving this systematic withdrawal of physical silver? Positioning. Smart money isn't waiting for January 1st. If you're an industrial buyer who needs guaranteed deliveries throughout 2026, you're not planning to negotiate under China's new state-controlled export system. You're buying now at $62 an ounce and storing metal in London or New York, where access is guaranteed. If this sounds exaggerated, history says otherwise. In 2010, China implemented similar export controls on rare earth elements. No outright bans, just licensing requirements and quotas. At the time, China controlled 97% of global supply. Within 18 months, prices for neodymium, critical for electric motors, rose over 500%. Dysprosium surged more than 2,000%. Western manufacturers faced an existential crisis. The US scrambled to restart the Mountain Pass mine in California, a process that took 5 years. Silver is even more vulnerable. Unlike rare earths, there is no fast restart option. The world's largest silver producers, Mexico, Peru, China, Chile, Poland, cannot ramp output fast enough to replace Chinese exports. Developing a new silver mine takes 7 to 10 years, once you factor in exploration, permitting, financing, construction, and ramp-up. And here's what makes silver uniquely fragile. Most industrial silver use is irreversible. When silver goes into solar panels as conductive paste, it's effectively gone. When it's used in medical bandages for antimicrobial purposes, it's gone. There is no circular economy for most industrial silver applications. So when China tightens exports on January 1st, and US buyers realize the open spot market no longer exists, replaced by state-approved allocations, there is no emergency reserve. No strategic stockpile. Just a scramble for whatever non-Chinese supply remains. Let's quantify what this actually means. Global silver demand in 2025 sits around 1.2 billion ounces, according to the Silver Institute. That includes 750 million ounces for industrial use, 200 million ounces for investment, 180 million ounces for jewelry, 70 million ounces for silverware. Total mine supply produces roughly 985 million ounces annually. Recycling adds another 175 million ounces, bringing total supply to 1.16 billion ounces. That's already a 40 million ounce deficit, before any export restrictions. Now consider China. China exports about 4,200 tons annually, or roughly 135 million ounces. If the new licensing system reduces exports by just 30%, that removes 40 million ounces from global supply. Add that to the existing deficit, and you're staring at an 80 million ounce shortfall, about 7% of global demand, with no immediate way to replace it. Markets rebalance deficits like this in only 3 ways. First, demand destruction. At $70, $75 per ounce, marginal applications become uneconomic. Manufacturers redesign products to use less silver. But this takes months of engineering and production adjustments. Second, recycling expansion. Higher prices make recovery from electronics and industrial waste viable, but scaling infrastructure takes 6 to 12 months. Third, mine supply response. But silver is mostly a byproduct of copper, zinc, and lead mining. You can't produce more silver without expanding base metal production, a multi-year process. That's why current prices around $62 per ounce only reflect partial risk. Institutional buyers understand what's coming. Most market participants don't. Major banks are forecasting $65, $68 per ounce by Q1 2026. That's far too conservative. Look at the gold-silver ratio, currently around 68. Gold trades above $4,200, silver at $62. During past supply crises, this ratio compresses sharply. In 2011, it dropped to 31. Even a mild compression to 60 implies $70 silver, without factoring in today's vastly stronger fundamentals. Solar alone consumes more silver now than total global industrial demand did in 2011. EV production is 10 times higher. This demand isn't speculative. It's structural. A realistic equilibrium price sits between $70 and $75 per ounce by Q2 2026. Now watch the timeline. December 31, 2025. Current export rules expire. January 1, 2026. State licensing system begins. Late December. MOFCOM publishes the final approved exporter list. January 15th. U.S. manufacturers lock Q1 supply contracts. Here's the bottleneck. The new licensing system won't be operational immediately. First shipments will likely be delayed 2-3 weeks. That creates a 30-45 day supply gap where U.S. buyers must either drain inventory or bid aggressively for non-Chinese metal. Expect regional price distortions. Silver in New York could trade $3, $5 higher than London. North American refiners will command premiums simply by eliminating shipping delays. So let's be clear. If you're holding silver at $62 today, you're positioned before the market fully prices in a supply shock that is already locked into policy. Could there be volatility in late December? Of course. Tax loss selling. Profit taking. Year-end position squaring. But none of that changes the structure. China restricts supply on January 1st. Industrial demand keeps growing. No alternative supply exists at scale. The smart money already knows this. ETF buyers pulling hundreds of millions of ounces out of circulation. Banks paying extreme lease rates. Manufacturers stockpiling despite record prices. They're not waiting. And here's the final reality check. The US produces about 30 million ounces of silver annually, just 2.5% of global supply. Even doubling production wouldn't matter. January 1st isn't symbolic. It's the moment China formalizes control over a metal modern industry cannot function without. The supply restriction begins in 21 days. The question isn't if prices rise. The math guarantees it. The only question left is whether you're positioned for what comes next.